Something is already happening, not in a way that interrupts your morning, not in a way that generates the kind of urgent headlines that would force you to pay attention. In the specific, quiet, institutional way that the largest financial disruptions always begin, beneath the surface, in the decisions that sophisticated capital is making before the public understands why those decisions are being made. Let me tell you what happened in 1929, not the version you were taught, not the stock market crash narrative, the Black Tuesday story, the dramatic single-day collapse of equity markets. That story is real, but it is not the story that matters for what I am about to explain. The story that matters is what happened to the banks. Between 1929 and 1933, 9,000 American banks failed. Not 9, not 90, 9,000 institutions. 40% of every commercial bank operating in the United States ceased to exist. Depositors who had done nothing wrong, who had followed every piece of conventional financial wisdom available to them, walked up to their institution and found the doors locked. Their savings were inaccessible, in many cases, permanently. But some people lost nothing, not because they were wealthier, not because they had political relationships that generated preferential treatment, not because they predicted the specific sequence of events that produced the crisis, because they had already built a structural architecture before the crisis arrived that placed no private financial intermediary between themselves and their capital. That distinction, not prediction, not wealth, not luck, but structure, is the entire substance of what I'm going to explain today. This is Capital Briefing. If you are here for the first time, subscribe now before we go any further. What we build here is financial intelligence designed for people who understand that the next wealth transfer does not wait for public awareness. It rewards early structural positioning. Subscribe now, activate notifications. Then let me show you the mechanism. Before I take you to the specific architecture, I need to make sure you understand the environment we are operating in. Because the 1929 parallel is not rhetorical decoration. It is structural. And recognizing the structural parallel in 2026 is the entire reason this video exists. Three things are happening simultaneously right now. The first, a bank in Chicago failed earlier this year. The regulatory filing is public. 82% of its loan portfolio was concentrated in commercial real estate and illiquid private equity positions, assets that cannot be quickly converted to cash, held against deposit obligations that could be withdrawn on demand at any moment. That structural mismatch, illiquid assets funding liquid liabilities, is the precise mechanism that produced bank failures in 1929, in 2008, and in March 2023. This was not an isolated management failure. This was a structural fragility. And structural fragilities propagate across systems in ways that isolated management failures do not. The second, the current administration has been actively discussing restructuring the Federal Deposit Insurance Corporation, not reforming it at the margins, potentially dissolving it into the Treasury Department. Staffing at the FDIC has been reduced. Budget has been cut. The regulatory experts who understand what this means are not staying quiet about it. Their concern is documented and public. The third, and this is the one that should stop anyone paying attention, congressional leaders from both parties are debating raising the FDIC's deposit insurance coverage limit from $250,000 to $10 million per depositor, a proposed 40-fold increase. Think about what that number means. A 40-fold increase in deposit insurance coverage is not a routine adjustment for inflation. It is not a technical recalibration. The only reason to increase coverage 40-fold is if the people who understand the current system's capacity believe that the current limit is materially inadequate for the stress scenarios they are analyzing internally. The people proposing that increase have access to the FDIC's internal risk models. They have access to the stress testing data. They have access to the concentration data for every significant bank in the country. When those people propose a 40-fold increase in the coverage limit, they are telling you something about what those models show. Smart money reads that signal before the public does. That is the environment. Now let me take you inside the architecture that the people who preserved wealth through 1929 were using. and explain precisely why the functional equivalent of that architecture still exists in 2026, available to anyone willing to spend 15 minutes building it. The fundamental misunderstanding most people carry about banks is the same misunderstanding that destroyed depositors in 1929. A bank is not a vault. It is not a custodian. When you deposit money at a commercial bank, you are not placing your capital in safekeeping. You are extending an unsecured loan to a private corporation. That corporation takes your capital, deploys it into mortgages, commercial loans, real estate positions, and investment securities at yields significantly higher than what it pays you, and keeps the spread. Your deposit is your asset. It is the bank's liability. If the value of the bank's assets declines below the value of its liabilities, if its loan portfolio deteriorates faster than its ability to pay its depositors, your unsecured claim against that institution is at risk. This is not conspiracy. This is how commercial banking has legally operated for 3 centuries. The advertising conceals the structure. The regulatory framework creates the appearance of safety, but the underlying mechanism has never changed. In 1929, that mechanism produced catastrophic results when bank asset quality, primarily loans to stock market speculators on margin, deteriorated simultaneously across thousands of institutions. The banks could not honor withdrawal demands. The doors locked. But here is what the standard 1929 narrative omits. Not all institutions failed at the same rate. Not all structures were equally fragile. And the structural difference between what survived and what collapsed follows a pattern so clear that it shaped the entire regulatory philosophy of the post-Depression banking reform, before that philosophy was partially abandoned in the decades that followed. The institutions that survived the 1929 through 1933 banking collapse at dramatically higher rates were not larger or better capitalized than the commercial banks that failed. They were structurally different in one specific way. They were owned by their depositors, mutual savings banks, savings and loan associations, credit unions, building and loan associations. These institutions were not owned by external shareholders with profit incentives independent of the depositor relationship. They were owned by the people who deposited in them. Their assets were concentrated in conservative local lending, home mortgages, small business loans, rather than in the speculative call loan market that funded stock market margin buying. When 40% of commercial banks failed, the depositor-owned institutions survived at a dramatically higher rate, not because of luck, because the incentive structure that drives asset risk decisions was fundamentally different. This is documented, it is not disputed, and it remains embedded in the legal architecture of every credit union operating in the United States today. Now let me take you to the other structural element that preserved wealth through 1929, the one that was intentionally removed from public awareness in 1967, and that has a direct functional equivalent operating right now. In 1911, Congress created the United States Postal Savings System. Any American could walk into any post office and deposit money directly with the federal government, not at a private bank. Not through an insurance fund that stood behind a private bank and promised to make depositors whole after a failure. Directly at the government itself. The deposits were backed by the full faith and credit of the United States, not a private institution's promise, not a regulatory mechanism, but a direct legal obligation of the sovereign. The postal savings system paid deliberately low rates, 2%, specifically designed not to compete with commercial banks for ordinary savings. Its purpose was not to maximize return. Its purpose was to provide a deposit mechanism without counterparty risk. When the banking system began failing in 1929, depositors who understood the distinction moved their capital. The data is unambiguous. Deposits in the postal savings system grew by approximately 800% between 1929 and 1934. 800% growth at 2% interest during the worst economic conditions of the 20th century. That growth had nothing to do with yield. It had everything to do with structure. Depositors were not chasing return. They were eliminating counterparty risk, and the outcome was absolute. Not one depositor in the United States postal savings system lost a single dollar during the banking collapse. Not 1 cent. While 9,000 commercial banks failed and millions of depositors lost access to their savings, some permanently, the postal savings system had a perfect record. The banking industry lobbied against the postal savings system for its entire existence. When the post-war economic environment stabilized, when the Depression-era banking reforms had rebuilt public confidence in commercial institutions, and when the political justification for a government direct deposit system had weakened, the lobby succeeded. In 1967, Congress abolished the postal savings system, not because it had failed, because it had worked too well, and because its continued existence represented a structural alternative to commercial banking that the industry had spent decades trying to eliminate. Now here is what that history produces for anyone paying attention in 2026. Subscribe to Capital Briefing if you understand why this history is not optional knowledge. Every video we publish adds another layer to the same systematic framework, understanding where institutional capital is already positioned, what signals precede the transitions that transfer wealth between those who see them early and those who recognize them after the fact. The next video examines the specific indicators that preceded the 2023 bank failures and how those indicators compare to what the current data shows. Subscribe now, activate notifications, then let me tell you where the postal savings system went. The Treasury Department operates Treasury Direct, a direct purchase platform for United States government securities available to any American, requiring a computer and approximately 15 minutes to establish an account. Through Treasury Direct, you can purchase Treasury bills directly from the federal government. 4-week bills, 8-week bills, 13-week bills, 26-week bills, no bank, no broker, no intermediary. The purchase is a direct legal obligation of the United States government. The same counterparty as the 1929 postal savings system, modernized for the digital era. A 4-week Treasury bill matures in 28 days, returning principal plus interest at the current rate, in the 4 to 4.25% range in the current environment. The proceeds can be automatically rolled into the next bill at maturity. The yield is competitive with or superior to most savings accounts. The counterparty risk is zero in any scenario that does not involve a complete collapse of the United States federal government. When Silicon Valley Bank failed in March 2023, when Signature Bank followed within 48 hours, when First Republic entered distress, depositors who held their capital at Treasury Direct experienced exactly nothing. The bank failures that generated emergency regulatory responses and required unprecedented intervention from the Federal Reserve and FDIC did not touch those accounts. The structural separation performed precisely as the historical record of the postal savings system predicted. Not because Treasury Direct depositors were smarter than Silicon Valley Bank's depositors, because they had no private bank intermediary in the chain between them and their capital. Now let me give you the complete 4-layer architecture, because Treasury Direct is one layer of a complete system, not the system itself. But layer 1 is the commercial bank operating account. This layer is unavoidable. Payroll, automated payments, debit transactions, the infrastructure of modern financial life runs through a commercially banked account. This is the utility layer. Its function is operational, not protective. The structural discipline for this layer is one thing. Do not concentrate more here than operational necessity requires. 3 to 6 months of normal monthly expenses, not a year, not everything. The operating account is where counterparty risk lives. Keep what is necessary there and move the rest into the layers that follow. The FDIC insures up to $250,000, but the FDIC's insurance fund holds reserves equal to approximately 1.25% of total insured deposits. That ratio is designed for isolated failures over time, not for the correlated stress scenario that the 40-fold coverage increase proposal implicitly acknowledges is being modeled. Understanding this constraint is part of understanding why the operating account is a utility layer, not a safety layer. Layer 2 is the credit union deposit under the NCUA's independent insurance framework. The National Credit Union Administration operates an entirely separate federal insurance framework from the FDIC, separate statutory authority, separate insurance fund, separate reserve structure, no shared exposure between the two systems, $250,000 at a federally insured commercial bank and $250,000 at a federally chartered credit union, or $500,000 under two structurally independent federal insurance systems. Not the same system with two names, two different legal authorities, two different funds, two different failure modes. But the deeper structural argument for this layer is the 1929 record. The depositor-owned institutions, which credit unions legally are, failed at dramatically lower rates during the worst banking crisis in American history. The ownership structure that aligns institutional incentives with depositor preservation rather than shareholder return is not historical curiosity. It is embedded in the current legal architecture of every credit union. The structural argument that produced the superior 1929 survival record has not changed. Layer 3 is physical cash in the correct denominations outside the banking system. The oral histories from the Depression-era banking holidays document a specific failure mode that modern financial education has entirely neglected. Depositors who had cash could not always use it, not because cash was rejected, because they had the wrong denominations. Large bills, 50s, hundreds, could not be transacted when the counterparty had no way to make change. Small bills, ones, fives, tens, 20s, transacted normally throughout. Denomination is not a minor detail. It is the difference between a transaction bridge and a useless asset in a disrupted payment environment. 1 to 4 weeks of normal household expenses in mixed small denominations held outside the banking system is not a wealth strategy. It is a transaction insurance policy. The cost is the foregone yield and the slow erosion from inflation. The function is specifically and narrowly maintaining the ability to conduct normal economic transactions during a period of digital payment disruption. Nothing more and nothing less. Layer 4 is Treasury Direct, the direct government securities account, the functional descendant of the institution that posted an 800% growth rate and a zero depositor loss record during the worst banking collapse in American history. No intermediary, no insurance limit needed, no bank holiday that can reach it, no margin call that can access it, no brokerage failure that can touch it, a direct legal obligation of the United States sovereign, accessible through a government-operated platform, requiring 15 minutes and a social security number to establish. The parallel to 1929 is not rhetorical, it is structural. The postal savings depositors who grew that system 800% were not making a prediction about which specific banks would fail and when. They were eliminating a structural vulnerability, the private bank intermediary, from the chain between themselves and their capital. Treasury Direct eliminates that same structural vulnerability in 2026. Let me now say directly what this architecture is not. Because Capital Briefing does not deal in distortion, and the 1929 parallel deserves precise framing. This architecture is not a prediction that a 1929 scale banking collapse is imminent. The regulatory environment is stronger. The institutional response capacity is more developed. The structural parallels are real, but the scale and likelihood are not identical. This architecture is not an argument that the U.S. banking system is fundamentally broken. The major commercial banks, J.P. Morgan, Bank of America, Wells Fargo, Citigroup, hold capital ratios significantly above the regulatory minimums. They are not the Chicago bank that failed. What this architecture is, the structural baseline that rational capital management suggests should be in place given the specific signals present in the current environment. The proposed 40-fold increase in insurance coverage, the FDIC restructuring discussion, the commercial real estate concentration documented in bank regulatory filings, the documented precedent from 2023 that structural separation between bank deposits and government securities performs exactly as the historical record predicts. The wealthy families that preserved capital through 1929 did not predict the crisis. They had built the architecture in advance and were in a materially different position when events that nobody expected actually happened. That is the entire lesson. That is the entire structural opportunity. The gap between how institutional capital and sophisticated family offices manage this specific risk and how retail depositors think about it is one of the most significant and least discussed asymmetries in modern personal finance. Institutional capital managers maintain multi-system architectures as a matter of routine. They do not concentrate everything in a single institutional system, regardless of how well capitalized that system appears. They understand the distinction between reimbursement security and accessibility security. They understand that being eventually reimbursed after a bank failure, while your obligations continue in real time, is not the same as having access to your capital when you need it. Retail depositors, with very rare exceptions, concentrate everything in one institutional system and assume the FDIC covers the relevant risk. It covers the reimbursement risk. It does not cover the accessibility risk. It does not cover the correlated stress risk that the 40-fold coverage increase proposal implicitly acknowledges exists. The architecture I have described, the operating account, the independent credit union layer, the physical cash transaction bridge, and the direct government securities account, exists to close that gap. It is available to anyone. It requires no special access, no minimum wealth level, no political relationship. It requires only the structural awareness to build it before the relevant scenario arrives, rather than recognizing its necessity when it is already too late to matter. Subscribe to Capital Briefing now if this video delivered the level of financial intelligence you have been looking for. Activate notifications. Each video we publish closes the gap between what institutional capital already knows and what the public will eventually understand, one layer at a time. Drop a comment. Tell me, which of the 4 layers represents the largest gap between your current structure and where the 1929 record suggests you should be? And what would it take, practically specifically, to close that gap this week? The wealthy families of 1929 who preserved their capital were not operating on predictions. They were operating on structure. The structure exists today. The signals are visible today. The only question is whether you build the architecture before the window opens or recognize its necessity after it already has.